Good afternoon, ladies and gentlemen, and welcome back to ICISA's Trade Credit Insurance Week. My name is Richard Wolf. I'm the Executive Director of ICISA and have the honor to introduce this panel to you. But first, on the week, the primary purpose of this Trade Credit Insurance Week is to increase the awareness and to showcase the TCI industry. We're worth it. Compared to other classes of business, we're quite small. However, we're important. We're important to the economies we live in, and we're important to the world economy. And for this reason alone, we should make ourselves be known to the world. This week, we already had a range of topics, starting with a keynote address on Monday morning, and some were strategic, some focused on specific areas of our small world. So yesterday, for instance, we had a panel on sub-Saharan Africa and the opportunities for our business there. And we have a number of focused topics, some call them more technical. And this webinar fits that latter category: artificial intelligence and use in this line of business. So there's a lot of talk on artificial intelligence. And you might or you would have used ChatGPT or BART or any of the spin-offs consciously. Now, if you use Google, which about 95% of the world does, you would have used it without knowing. The big question is not if, but when and how we can use AI applications in credit insurance. Now, on Monday afternoon, you may have heard one of the panelists say that AI is used almost exclusively for buyer underwriting and maybe claims, but not for exploring commercial opportunities. And that could well be true. Having said that, I'm not too sure how advanced we are as an industry. And this item of the TCI week is meant to put us past the theory, because the theory I think we've all read, and putting AI in practice in a major way. This item, is to look at that practical use of AI and to dispel some myths. And you will receive some insights from our three distinguished panel members. You can ask questions, everything you ever wanted to know about AI, but were afraid to ask. And for that, there is a button on the bottom right-hand side of the screen called Questions. You're still most welcome to register for topics you haven't registered for as yet. And this will also enable you to watch the items of the TCI week at a later time, in case you were not in a position to watch live, or to show it to your colleagues. And we will make all the items of the Trade Credit Insurance Week available through our website, icisa.org. So, having said that, gentlemen, I would ask you to introduce yourselves to the audience, maybe starting with Bill.
Good afternoon, all. It's morning here in Colorado, so just getting started with our Wednesday. Thank you all for the time. My name is Bill Quadrini. I lead market development in the Americas for S&P Global Market Intelligence. Specifically within that, our credit and risk solutions, credit analytics business. In this business, we have a number of different tools that we work with clients on. Tools around credit scoring models, financial spreading models, things like data, certainly to power not only our models, your internal systems, as well as analytical services, and then something more specific around climate risk modeling.
Thank you so much. Robert, could you introduce yourself, please?
Yes, thank you, Richard, for the opportunity to discuss AI for trade credit insurance in this panel. And congratulations to the very successful ICISA week so far, trade credit insurance. So my name is Robert Metis, Director Global Business at Schumann and Director Schumann International in London. For the people who do not know, Schumann has been expert in credit risk management for over 20 years now. We are providing in the field of insurance, underwriting software for trade credit insurance, and a complete solution for an end-to-end process in the surety business. So I'm happy to discuss AI.
Thank you so much. And last but not least, here's the professor sitting in front of the blackboard. Olivier, could you introduce yourself, please?
Yes, absolutely. Thank you very much, Richard. And thank you to the other panelists and all the participants. Glad to be with you today. My name is Olivier Placard. I'm co-founder and CEO of Tinubu. At Tinubu, we are a leading vertical SaaS vendor specialized in credit insurance and surety line of business. We provide mission-critical solutions to insurance carriers to digitally distribute and manage the entire life cycle of their insurance products from end to end through our platform. Additionally, we have a small team of 20 people out of 200 resources that we have that provide credit recommendation services. And this is the specific area where we use artificial intelligence to support risk assessment and in the decision-making process. So I'm happy to provide you with some visibility on what we do in relation to AI and how we do that.
Thank you so much, Olivier. Now, ladies and gentlemen of the audience, what we have discussed is that each of the three gentlemen will hold a short presentation, and afterwards we have the opportunity to ask some questions. And Bill, maybe I can start with you. I know you've got a presentation lined up, and I invite you to deliver your comments, please.
Awesome. Thank you. Thank you, Richard. So, title for today, Artificial Intelligence, Trade Credit, how S&P kind of works with our clients around this, what we're seeing, hearing from the marketplace, and some thoughts around best practices. So if you want to go to the next, just some high-level agenda items. Not going to spend a huge amount of time in slides today, but wanted to lay out some of the particular challenges that we've seen with our clients, that we've helped them work through, and some of the particular things to think about, both in terms of the automation, and then once we've kind of connected the data, the systems, the processes together, how and where we can think about adding things like AI into this. Next slide, please. Oh, back one. Perfect. So one of the key things for us is we've seen a lot of clients talk about gaining efficiencies. And the key questions is, how do we take what is an extremely manual process and apply, first of all, automation to it? How do we update our systems? How do we connect our data sources? How do we connect front office to back office? You know, and as clients get larger, as clients get more complex, right, just internally, forget about externally into different product lines, it becomes really hard for these systems and these people and processes to talk together. So one of the key things is, as we look at this, the major decision points, if you will, how much credit should I extend? Or in this case, as I'm looking at underwriting trade credit insurance, how do I determine those limits? Where am I going to incur losses? How do I mitigate the exposure to the underlying risks? Once we've got that, we've got a credit engine in here, right? Rules-based. We recommend using things like rules-based decisioning. And then you've always got kickouts that go to your credit analysts, your underwriters, your senior management for business decisions to make those, you know, final adjustments to it. One of the key benefits to automating that underwriting data workflow is that you get to faster decisions, right? Auto approving for yes, auto declining for no, spending your analyst resources on those in between. Certainly, we're hopeful for reducing operating expenses, right? We all know how thin margins we operate on. The industry is generally very competitive to hyper competitive. And then pricing, of course, depends on the market, but key consideration, and obviously some place where we want to gain those efficiencies. Next slide, please. We think about this in really 5 key stages. So when we think about the origination side, we've actually worked with a couple of clients who are being proactive. They're trying to boil the ocean. They're saying, how do I screen the potential universe of all companies out there so that if and when they come to me, I can already have preset credit limits, right? We think about things like the collateral or deal structures, right? Are there external supports? How are we considering, our primary insured, and then of course those secondary insureds? Portfolio management is something that I think most organizations struggle with. It's always something very high level talked about, but we've not really seen a lot of people who are happy with their internal management. It's always on that kind of watch list and exception management basis, rather than being able to truly be proactive and start to look out across industries, geographies, segments to say, where are the risks coming and how can I get in front of them while I can still take those meaningful actions to mitigate the risk. Credit analysis is something that everyone is pretty familiar with, right? It's a key part of what we do all day, every day. I need to understand the credit quality of my insured or, part of that portfolio. How much limits do I extend? What are the terms? How are we kind of mitigating these things and pulling this all together in that final decision to our customer? Next slide, please. So we think about each of these different aspects, right? And again, as we're going through each of those 5 key critical areas, automation, right? How can we take the best of breed of data, populate our systems, mitigate the impact on our credit analysts of cutting, pasting, researching, preparing everything in a nice, neat box to them and or to our originators and telling them, here are the best guesstimates of the client and the potential business we can win. How can we use data and systems, AI, to be able to really get in front of this and to helpfully mitigate the time and effort to find new customers? Next slide. When we get into the automation for the actual analysis, right, we've got all these different data sources. One of the key elements is always looking at financial statements. We at S&P have built a tool to automate financial statement spreading. This is actually true AI. So step 1 in this is taking a document, translating it into an image, doing things like optical character recognition. But then the AI comes in and says, how do I match, revenue to total revenue? How do I match tax expense to tax expense? Understanding that, making that a crowdsourced place where the machine learns over time. And again, it is a way to be more efficient. Looking at things like, how do we establish credit limits? Some of our customers have very detailed models. They're very math-based models to be able to say, this is how much we'd be willing to extend in credit. A lot of clients are more like, we kind of feel it's on this range. We, of course, recommend having systems, having policies, having more math-based systems, and then people make the decision in order to increase or decrease based on other business considerations. Next page. That decisioning process, and I think Olivier and Rob will talk much more about this, right? Having workflow systems that enable efficiency inside the organization. Credit analyst does something. The old days, we had paper, we had fax machines, right? Today, we've got email, and we spend most of our time managing email. But you want systems to truly be able to say, hey, I've approved this, kick it up to my manager, let them approve it, kick it up to the final sign off, let them approve it, and have automated notifications, right? Using the best of technology as well as human decisioning through this process is one of the most important things, and defining where each of those critical points can be. That's really been the place we've seen organizations win and do really well and make it a competitive advantage for them, and others who are much more slow and it's a much more manual process. Next slide, please. When we get into surveillance, portfolio surveillance, right? This again tends to be something a lot of clients struggle with. It is obviously, we've got those names out there we're worried about, and we can look at things in terms of absolute risk levels, but managing that portfolio, understanding where emerging risks are coming from, frankly, being able to have a portfolio of 500 or 5,000 or 50,000 names in one place, being able to look at various characteristics, whether it's frequency, whether it's the severity, whether it's, term, right? These are all critical considerations. And just getting that information into a place that is both real time and gives us the critical pieces we want. The second step to this, we think about trigger mechanisms. So tell me automatically, without me having to scan my 50,000 names, where do I spend my time and attention? Who are these really good names I don't need to spend any time on? And then where are those other ones? Where are payments getting delayed, right? Where are we seeing risks? What sectors? A lot of key considerations. And one of the most important aspects for this is the business environment. And I think that as we've seen, we've been very fortunate over the last few years in being in a low default environment. We're starting to see defaults tick up. I know S&P has said that August was the most defaults in any single month since 2009. So the business climate is changing. We know there are risks out there. Getting in front of this is critical for our success. Next slide, please. What are our deal terms? What are those external pieces of support? Managing them, right? A lot of our clients will have things like letters of credit. They'll certainly use your surety bonds for this. New product I've heard called on-demand surety bonds for the trade credit space specifically. Having this in their systems as well as in your own, again, critical piece of this. We can look at all the deal side analysis. This is really one of those things that makes a difference. Next slide. When we think about early warning really starts to mean something newer. Within S&P, we're kind of in a stage right now where we are working with clients in a beta format for an early warning system. It's a product release we're coming out with at the end of the year. We've got a framework that looks at this that says, okay, I've got a portfolio of high-risk names, but how do I actually spot the ones that are going to be negatively impacting me? How can I find those bad outliers? And so there's a number of things that we incorporate into this. Again, it requires having all my information together. Scenario analysis is something that's really critical. Being able to take a particular view of what's happening in the economy. So we all worry about energy prices. We happen to work with a lot of energy firms, as I'm sure a lot of you do as well. What happens if the price of a barrel of oil goes back to 140 a barrel? What's that do to the credit quality across the entire industry? And while it's good for producers, it's bad for all the rest of us. So how do we mitigate that if we can't even identify it? Do some scenario analysis, be able to say, in this state of the world, if this happens, here's what it looks like. And that enables you to be able to prepare plans. Country risk is an area we see a tremendous amount of interest right now. Country risk is really, as we think about it, the risk of doing business in a country. We want to separate that from the risk of a country not repaying its debt. There's a lot of things that go into this. Political risk is a big piece of it. Thinking about economic environments, legal, tax environments, right? All of those pieces need to be incorporated and understood in the context of a credit product, such as trade credit insurance. How does doing business in this country affect the overall climate, number one, and then number two, in the event of a default, what are the legal remedies in that country? Major piece for us to be incorporating. Other elements from that early warning system, right? I know as a credit manager, a lot of time is spent scanning the universe, reading different news sources, synthesizing a view of the world, understanding what's going on in retailers versus automobile manufacturers. Here in the States, we're having a union strike across autos. What's that going to do? A lot of these things need to be incorporated into our views. We could back the slide up one, please. Perfect. And then, right, taking that, including those other, let's call them sentiment scores, into our credit views is a critical piece in our early warning. Last piece of kind of early warning is having all of these things linked to your system of record, right? Let's really enable technology to do what it should do best, and that's give us key data to make decisions on. Next slide. Key place that a lot of our clients struggle with is around financial statements. How do I make decisions on a portfolio of 1,000 names when I've only got financials for 20 of them, or 50 of them, or 500 of them? We, again, product, have come up with a methodology that scores companies based on our database of actual private companies, as well as other market-based factors. We include all of these things into tool sets to help our clients make decisions when they don't have financials on those underlying customers. Some of those things include, right, really detailed credit analysis on a portfolio, on a universe of comparable clients, looking at qualitative assessments, having things like market-based factors, and then, of course, business-based factors. How much are you going to repay? How likely? What's an expected loss, etc. Next slide. Last piece, we got a lot of modeling around climate. This is a key thing. What's the credit transition based on climate factors going to look like? We could do this over the next 1, 2, 10, 30, 50 years to understand how carbon neutral policies are going to have an actual impact on individual credit customers. Last slide. Thank you.
Much, Bill. A lot of wisdom to be gained from your presentation. What I took away, some companies are trying to boil the ocean, and that doesn't work.
Right.
If somebody tells me where to spend my time, and it's not my wife, that would be fantastic. And the early warning systems play into that. I shall remember that, and at the same time ask Robert to deliver his remarks, please.
Yeah, so thank you very much, Richard. Simply to start with, Schumann, well, we've been in the market for more than 25 years, and we've ever applied technologies or methodologies in the space of AI. So expert systems as a starting point in the early days, and then it moved on implementing solutions, applying methodologies like neural networks and all this stuff. So not to be too technical here in this field, so it's developing constantly in the solutions. And what we see today is that there is a high need, and in the field of data analytics, data science, applying AI technology. And that is also for our solutions in the field of insurance business, so trade credit insurance and surety bond business. And as mentioned before, we are one of the market leaders providing such underwriting solutions. But I want to move forward just to focus on what we should look at the moment. So I think it's very important to get the focus precise, what we want to discuss in terms of machine learning and artificial intelligence in this session. And first of all, I would like to narrow down the topic a bit. And the field of artificial intelligence is very broad. It includes rule-based systems, so-called expert systems mentioned before, but various other applications that could be applied. And today, I want simply to emphasize three topics here, applying machine learning and artificial intelligence. And that's in the field of using payment experiences, ratings, and underwriting. But I'm happy to say that what you said, Bill, with all the explanations as an information provider, data information provider with all the technology in the background, we are happy to have more than 50 partners providing that kind of data in our solution for the underwriting purposes. So, and the question is now, in that kind of underwriting system, to use payment experiences, generate ratings, and supporting the underwriting in the field of limit decisions. So therefore, the data sources I would like to refer to is payment experiences again and annual financial statements. We heard some explanations already how to apply AI in the field of annual financial statements and financial data. But what is the outcome of all of that? First of all, it is clustering of portfolios. It's clustering of the bias you have in trade credit insurance in your portfolio. The next thing is forecasting related to the payments. What could you expect in terms of incoming liquidity, and forecasting of insolvencies, and that is key for the trade credit insurance business, and supporting the underwriting. I will come back to that later on. So what I have here for you is not the slides for sales purposes, rather than it's the outcome of a real solution. We got a portfolio of payment experiences, and when we are talking about clustering based on the methods, finding out clusters AI based, what we can see here is you will find buyers who pay on time or discount or early. But I think the most critical things are here in the inconsistent, highly inconsistent field, and the late payers. So clustering is something that is so crucial in that respect when we are talking about machine learning. So the system is being trained based on the data that we have available for that certain purpose. The next is that we want to see a little bit more precisely into detail. What are the developments of payment behaviors? So that is in the background. So you saw the clustering, but next we could have a insight regarding a buyer payment behavior. And I took one example that's coming from the COVID-19 crisis. So you see it started in 18, that was a discount payer, and that was on time 29, and then it happens that there was a late inconsistent payment behavior due to the fact that there were the outcomes and the impact of the COVID-19 crisis. And after extreme payment delays from the middle of 19, the payment behavior has leveled off. And what we saw then until 22, that it balanced back to on time. So what does it mean? Bill already mentioned early warnings, and that's the way we handle that in underwriting software, that of course we identify based on the data we are looking at and analyzing at, that there could be a change of payment behavior that would have an impact on the forecasting what the payment behavior will be in the near future, and what does it mean in terms of insolvency forecast. And that's exactly what I would like to refer to in the next slides. So this is an example of a certain portfolio that we analyzed. So first of all, I would like to explain a little bit what you see here. So on the left-hand side, there is a rating scale. So AA, which is positive, and D is default. And we use only payment experience evaluation with the previous logic. What kind of logic is that? That is coming from an expert system. So it is rule-based with scorecards, etc. And what you see is that we could analyze based on payment experience how solvent or the probability of insolvency is based only on payment experiences. And that was the starting point. And now we had to look into the application of an AI model. And what we see here is that there is a shift in the solvent and insolvent ones. Just picking one. When I pick one, that would be maybe the default. And you see, we could recognize in a forecast of 3 months that in the previous logic, we could identify three insolvent companies. And applying the AI model, we identified 15. But it's not only in the field of D, the insolvent ones. Of course, it's very important in that respect. But please look at the C ones, the triple C, double C, and C. That also has an impact of late payment that is related to that. And looking into the trade credit insurance policies, of course, there are obligations in terms of collection and collection services. So there is an identification in the C, which is much higher and in double C than in the traditional system. I would like to move on that we, of course, not only looking into payment experiences, but I wanted to show you what the power of analyzing payment experiences solely is already. Of course, if you would combine that kind of data with other data coming maybe from rating agencies or maybe from Standard & Poor's as a partner of ours, as an information provider of financial data analytics, of course, if you combine additional data, it's much more precise. So this is a different portfolio here. And again, what we did is only to apply payment experiences AI technology. So first of all, in the traditional system, the expert system, you see that we identified 21 insolvencies, and it raised up to 31 based on AI methodologies based on payment experience. Other data are constant; they have not changed. So what does it mean? So there is a high power using payment experiences and applying AI technology already. If you would imagine that the information providers and additional information analytics based on AI could have a similar power somehow, of course, not that powerful as payment experiences because they are very close to the business, but additional information that could be relevant, then you would even increase the rate of insolvent companies' identification. And that is very important to understand. Applying AI technology should be done in a way that you should focus on certain application, finding out and getting more and more precise in the course of time, applying that technology based on additional information that is relevant. And the power of AI is, compared to the human capabilities to analyze, that the relations between data could be much more easily identified and weighed. And that is so important that this system could explain how the impact was of certain variables in terms of data, of certain impact of data that you're analyzing and taking into account for your purposes. So underwriting, on the left-hand side, you see that, of course, in traditional expert systems, you're taking already credit bureau ratings, bank ratings, financial statements, or payment history into account, which is embedded in scorecards. And scorecards, in the end, tend to be a little bit too static. So it is based on certain experiences, and of course, it will be validated all the time and checked. However, you're generating more loosely based probability of default based rating. The power of the machine learning in this respect is that you could add various additional information, and that additional information could be various ones in the field of financial statements, maybe, and what the internet has available as data that could be relevant. Text analytics are developing and could be embedded as well in the system and evaluated and weighted all the time. To calculate a probability of default and a rating confidence value regarding the validity of the system. So what does it mean? That would have an impact on the limit decision in the way that there is a capability to support the underwriting, applying that kind of systems to help the underwriters to focus on the decision-making process, on negotiations in terms of policies and negotiation with the policyholders in terms of obligations and all this stuff. So what we see to conclude is that there is high power and there is confidence that this power could be applied in the solutions for underwriting to help the underwriters in the analytic and data science field. And I think it's quite promising to see that the outcomes are really interesting and already reducing defaults and claims. So that's from my side for the time being. Of course, I'm happy to answer the following questions.
Thank you so much, Robert. And for those of you who saw the item this morning on sustainability, there it was said, we don't have numbers, we don't have measurability. And I think in this field, looking at Robert's stats on payment experience, we are slowly getting there. So we're making progress. Thank you so much. Last, not least, Olivier, may I ask you to deliver your remarks?
Yes, thank you very much, Richard. Very interesting presentation by both Bill and Robert. As I mentioned before, at Tinubu, we have been in the business for over 23 years now. And we have been providing credit recommendation services for our customers. So we have a huge volume of data that is available on our database. Obviously, we pull data from information vendors. We're connected to something like 27 information vendors, out of which S&P, and we consume their data, which is very well done, by the way. So we get to tackle this, to contemplate a little bit how we can use AI. And it is important to note that at Tinubu, we have our software that we provide as a technology platform, and that we have recommendation services, risk services for our customers. It's in the second field, the risk services, that we apply the AI, and the following step for us will be to bring that as a feature in the software. We are not there yet. We are at the stage where we can use this for our own underwriters. So a lot of data is what you need actually to go through the AI experience. But when we talk about AI, from our perspective, this is not really a new subject. 20 years ago, when we started Tinubu, we were already using a form of AI, which at the time was just some very sophisticated algorithm based on rules to predict probability of default and enhance automation. Since then, actually, what have changed is the underlying technology. A new form of AI has emerged and is now available: machine learning, deep learning. And this allows to train models based on significant amount of data that we could not ingest before. And there are two things that are very important that are needed to build those models. First is a full set of data. And not only the data need to be really clean, because otherwise you're running into troubles in the outcomes that you're delivering. And the second one is that you need to have a clear target on what you want to achieve, actually. So once the thing that we have in mind was going through AI journey is to have something that will help our underwriting team, but in a way that it's not a black box. It's something that we can really explain. Okay, that was very important for us because we are operating in an industry which is regulated, and there are some regulatory constraints to be capable to justify the decisions that are made. And as you know, there is this European AI Act that consider that this is a very sensitive topic, so it needs to be justifiable. So it was one of the dimensions that was really important. And finally, the last part is, once that you have the model, it's the ability to, of course, train the model, but also to monitor. So those are the 5 key elements that we consider when going through this AI journey. So you asked the question, Richard, at the very beginning. You said people really think that AI is applicable for credit decisions and claims mainly in our industry, which is not true, because there's a lot of other areas where we can apply AI. For example, in distribution, by automating some sales campaigns generation, by producing recommendations on what type of product to be used based on the questionnaires that are being filled by the policyholders, by enabling a very efficient and enhanced workflow on how we're going to treat the information that is coming from the different parties. And it provides a lot of benefits as well in terms of cross-selling and upselling possibilities, in terms of how we can customize specific product and services for a specific profile of customers. It increases the quality of the service. It provides a better user experience as well. So there is a lot of things that can be done on the distribution. Of course, on the underwriting, there are different use cases, and we're going to specifically talk about one use case, which is what we've done on the risk models and how we support our underwriters in their decision-making process with AI. But there are other things that can be looked at. For example, in terms of time horizon, we look at risk most of the time short-term, but we can have a different time horizon leveraging AI. We can consider not only short-term, but as well medium-term. We can leverage unstructured data, and Bill talked about this previously in his presentation. And all this will improve the risk assessment, will enable to have a more comprehensive risk analysis in the underwriting part. In the policy administration part as well, there can be some improvement that can be done there in the way you're processing all the information that you're getting and the interactions that you're having with the policyholders, with the brokers, and provide some assistance in self-servicing all these people. And finally, in the claim, and we discussed a little bit this previously. So there are really different domains in the credit insurance end-to-end processes where we can apply AI. Now I'm going to talk about what we at Tinubu has done, and it's going to be specifically in the underwriting field. So actually, as I mentioned before, we provide risk services to our clients, and we have a very large set of information. That was the starting point for us to make the decision about, okay, how do we leverage this a significant set of data and historical set of data that we have, and how do we use this to provide a better outcome for our underwriters in their decision-making process. Usually, it's well known that if you want to predict the future, you need to have a very good learning and understanding of the past. So there's nothing new there in creating in artificial intelligence, which is applying the same type of principles, but leveraging technical capabilities that were not there some years ago. So using that data, we went through our lab. At Tinubu, we have a lab which is made of 5 people mainly, and the objective is to foster innovation, to actually look at the technology, look at how we can master that technology, and do a kind of proof of concept. And from that proof of concept, we will have conversation with our customers on how we can leverage that to provide them a specific service. We've done this with blockchain a few years ago, and this is what we're doing with artificial intelligence. And our focus was really to look at our algorithms and our models to analyze the risk, to assess the risk, and to provide a better productivity efficiency to our underwriters by providing them actually the recommendation of what they would have done if they have all the set of data available, and if they have the historical view of how they have made the decision in the past. So this led to a clear objective that was set, which is to improve the speed and quality of service. That was the very first thing for our underwriters, to leverage historical decision to assist the underwriters in their analysis, and to provide the users with a set of reports directly in our platform, in our credit insurance platform. The team is making like 250,000 decisions a year. Over the past years, we've been able to analyze more than 1 million of companies. So we had to select and define a set of data, which is the scope of data we were going to work with and we were going to feed the machine learning with. And we set some targets in terms of how much data per type of data that we're going to use. From there, we went to the selection of different type of algorithm. So we tried many different things. So we have a list here of different algorithms that we test. And ultimately, we train those models and we come up with the creation of our own model with 6 different dimensions. One is the credit scoring, of course, with the probability of default. The other one is the risk appetite. Another one is the country scoring. The sentiment analysis, it's a dimension that was important as well. And then the ability to have the report summary that enable the underwriter to make decisions. The outcome of this was fairly good, actually, because what we did was based on data and historical decisions that were made by the underwriters, training the models, we're trying to replicate the decisions that were going to be made if we're in presence of a certain type of information. And we had 80% plus accuracy on this. So the question for us was this something we're going to use in an automated way and have the system to make the decision? Or is this something that is going to lie with the underwriter to decide what they're going to do with this? And our philosophy at Tinubu, and given the performance that we have, is, well, actually, we're going to provide a recommendation, a support for our underwriters, and the underwriter will have the final call. Okay, that's really important because we consider that the human is above the machine, actually. And it's a support for our underwriters rather than to be a system that will automatically make decisions without no control. Okay, so that was the journey we went through, and we have been able to provide our underwriters with a set of information that really enable them to save a lot of time, to go much faster in the decision-making process, and to be extremely reliable. So what we are thinking about our next step is, okay, how are we going to bring this as a product feature in our solution for our customers, our customer base, and we are in the process of working with each one of them to understand the set of data that they have and to go through the process with them and to enable them to leverage AI in their decision-making process. With that, I'm done.
Well, thank you so much, Olivier. It's very bold, and it's very good to hear to say that when we talk about AI, this is not really a new subject, just the tech has changed. I'm going to put that one above my bed. We have a couple of questions, and we have time for maybe 2 of them. And let me start with the management question, please. When and how will AI influence the expense ratio of insurers and reinsurance and their headcount? Does any one of you want to comment on that?
Well, maybe if you would allow, I could start. So, well, I think what we said earlier is that AI is not really new from the technical side. It's been applied for a while, and what we've seen is that the application of AI-based technology already reduces expenses in the underwriting field, and also in the field of identifying potential claims and insolvencies. I just want to make a remark regarding headcount. So I think that AI-based solutions are supporting the underwriting. This is very, very important to understand in terms of data analytics, data science, and in the various fields that you could look at, whether it's risk or other areas in the field of the insurance business. So regarding the headcounts, of course, when you're relieved from certain routine works in that field of data analytics, that reduces the effort and leads to other opportunities, maybe to develop business in a different way, maybe down to thinking about new or other products in the market.
Yep, and I can echo that, because what we see is that, okay, first of all, we don't think about reducing headcounts. I don't think that's the right way to look at the usage of this technology, because the reality is that maybe, yes, you can reduce some headcount. On the other side, you have the increase on the IT costs, because this is not free of charge. There's some expense related to that. So one way or another, the gap will not be that significant at the end of the day. But what it can do is that your users can spend less time on a task that has no value added, and spend more time where it needed. Okay, so maybe on products, but on some specific decision that require more time, you want your underwriters to spend the value there. And the other thing which is really important is that it can enhance significantly the customer experience. It can provide more satisfaction to the customer the way we use it. And of course, yes, it can have an impact in the claim ratio, which at the end of the day are the great benefits you're going to take from this.
Bill, any comments from your side on this one?
No, I think Olivier and Rob have said it well. It's going to be many, many, many years before we'll be anywhere close to that point. I just a personal anecdote. I think if everybody's played with ChatGPT, and your first reaction is, "Oh my goodness, like this is really good," and then you start looking into it and you read a little deeper, and it's written by a happy idiot, right? Like it goes to a certain level, but it doesn't get beyond. And if you actually have any really deep knowledge, it can't come close. Now, it can do a lot of grunt work for you. It can pull some things together in a very good fashion, but you really need to apply critical thinking and expert judgment. And that is where human beings excel. So until we can replace that, again, my feeling is it's not going to be anytime soon.
Yeah. One more thing, Richard. And you know that very well because you've been an underwriter yourself. Don't forget that in underwriting, there are two dimensions. Of course, there is the data that you use, but what the underwriter has and the machine doesn't have is the subjectivity, right, in the decision-making process. And that you cannot replace that with AI.
Make me very happy that you say that, because subjectivity remains, on the one hand, essential for underwriting, but it also ties into a question that just came in from the audience. And that is, when the AI is used in the decision process of a company, how will that change or influence the governance of the company itself? That's a good question and ties in with the subjectivity. Gentlemen, who wants to have a shot at this one?
I'm going to leave that one alone. That's actually a very good question. I just need to think through it.
And I think what, I don't remember whether it was Olivier or Robert said, every decision must be justifiable, every decision must be explainable, plays a
Yes.
very important role in that, right?
Yeah, so I think what is really important, maybe just a quick remark here regarding explainability, and that touches also maybe the question of governance in underwriting. Of course, underwriting needs to be based on certain data and evaluation and a certain result. And the result needs to be explained. And of course, there's also technology available for that. And that is very important, and that is key. So applying, for example, Shapley additive explanations and the technology which comes from the game theoretic approach, but explains the outcome of machine learning and artificial intelligence itself, so that you could see what were the data and how to weight the variables within one single solution. So maybe what was the impact of the payment experience? What was the impact of certain key values coming from financials, etc. So explainability is very important, and that is part of governance in the field of underwriting. And technology is there and is needed, and I think this is one of the prerequisites. Embedding and implementing such solutions in underwriting, or maybe if there are new products maybe coming in the trade credit insurance field, to explain towards a customer regarding any decision regarding the coverages.
Excellent. Thank you very much. And I think with this, we have come to the end of this item in the TCI week. We could easily have gone on for another day, right? Because this is a topic which you can scratch the surface in an hour, but if you want to go deep, I think we will need to book hotel rooms, invite Robert, Olivier, and Bill, and have them speak for literally 3 days. At the moment, we don't have the time, but I would like to thank you three very, very much for the insights you've brought to us. They are valuable. I'd like to thank the audience for your attention in big numbers and your thought-provoking questions. Now, any other questions that you'd like to ask after sleeping on it for a night, please pass them to us via our website, icisa.org, or to secretariat@icisa.org. And the questions which have not been answered, I will put to the speakers in question and see that you have an answer. I remind you that this webinar, just like all the other ones, can be seen as of probably the beginning of next week via our website under the resources section. But I would like to ask your attention for the TCI week item tomorrow morning, 9 a.m. UK, 10 a.m. CET, and 3 p.m. in Hong Kong and Singapore, 4 p.m. in Tokyo. And I'm emphasizing this Asian time zone, or the Asian time zones, because we are going to explore trade credit insurance in Asia. Not new, still developing, and there is plenty of space for opportunities and strategies for success. Tomorrow afternoon, we'll be discussing the re-emergence of political risk, and I would love to see you there. Until that time, thank you very much for your attention, and this is ICISA signing off from Schiphol Airport in the Netherlands. Thank you.
Thank you all.